Before we begin, just a quick note. This podcast is produced by qualified financial professionals and is intended to share general information and insights to help expats better understand common financial topics. However, everyone's circumstances are different and regulations can vary by country, so nothing discussed should be taken as personal financial, tax, or investment advice. If you're considering making financial decisions based on anything covered in this episode, we recommend seeking professional advice tailored to your individual situation.
Hi, I'm Georgina, and you're listening to Expat Money Matters. At Chase Buchanan, we know your time is valuable, so we've taken our signature weekly market update email and turned it into this easy-to-digest audio briefing, so you can stay informed while you're on the move. Here is your weekly update for the 19th of August 2026.
Good morning or good afternoon, wherever in the world you find yourself this week. After the United Kingdom's fifth heat wave of the summer, temperatures are finally expected to ease, with cooler and more changeable weather on the way. For a short while, the British weather has felt more like one of Europe's sunnier expat destinations. Of course, warmer weather is one of the reasons many people move abroad, but there is much more to the decision than sunshine. It can also be about finding a better place to grow a business, making retirement income go further, understanding how investments will be taxed, and keeping up with rules in more than one country. This week's update covers all of these areas. The United Kingdom and United States economies are moving in slightly different directions. Canada is approaching an important tariff deadline following a fresh rise in inflation. Disruption in the Strait of Hormuz also remains a concern. Several practical deadlines are getting closer too. Businesses interested in the Canary Islands Special Zone have until the end of 2026 to complete their registration. Investors affected by Belgium's new capital gains tax may need to contact their broker before the end of August. And Malta has clarified an important deadline for people considering one of its existing residence programs. A quick note on timing. This episode is based on the weekly market update researched on Monday, the 17th of August, and updated on Tuesday, the 18th of August, 2026. First, the United Kingdom and United States economies are sending slightly different signals. US inflation eased in July, with the annual consumer price index falling from 3.5% to 3.4%. Retail sales declined by 0.6%, suggesting that American consumers may be becoming more cautious. Together, these figures reduced expectations of a Federal Reserve interest rate increase in September and placed some pressure on the US dollar. The UK economy, meanwhile, expanded by 0.4% in the second quarter and 0.3% in June. However, figures released on Tuesday showed that the UK labour market is cooling. Unemployment remained at 4.9%, while the number of job vacancies fell to 707,000. This was the lowest level since 2021. The latest figures make an immediate Bank of England rate increase appear less likely, although inflation remains an important concern. For expatriates, changing rate expectations can affect sterling to US dollar exchange rates, pension income, and international investment values. A stronger pound benefits those converting UK income into euros or dollars, while reducing the sterling value of overseas income. UK inflation figures and the Federal Reserve's latest meeting minutes are due today, on Wednesday, the 19th of August. Both will provide further information about the possible direction of interest rates. Next, Canada is approaching a high-stakes United States tariff deadline. Canada and the United States are continuing negotiations ahead of a potentially significant deadline. On Wednesday, the 19th of August, the United States has threatened to impose 50% tariffs on approximately $20 billion of Canadian goods. The proposed tariffs could include products that would otherwise benefit from the United States, Mexico, and Canada trade agreement. The latest reports suggest that the two countries remain some distance apart, although negotiations are continuing. Discussions have included the possibility of reducing tariffs on Canadian vehicle imports, but important differences remain unresolved. Canada enters this period with a comparatively resilient labour market. Employment rose by 75,000 in July, while unemployment fell to 6.4%. Canadian inflation also increased in July. The annual inflation rate rose from 2.8% to 3%, placing it at the upper end of the Bank of Canada's target range. Higher petrol and travel costs were important reasons for the increase. However, the measures used to assess underlying inflation remained close to 2%. This leaves the Bank of Canada with a mixed picture. Inflation has increased, but the underlying figures do not currently point to a broad rise in price pressures. At the same time, new tariffs could weaken business confidence, affect employment, and increase costs in some industries. The deadline does not automatically mean that tariffs will take effect exactly as proposed. Negotiations could still produce an agreement, a delay, or a narrower set of measures. For anyone with financial connections to Canada, the outcome could influence the Canadian dollar, interest rate expectations, and the value of income or investments converted between currencies. Turning briefly to the Strait of Hormuz, earlier diplomatic optimism has not translated into a wider recovery in shipping traffic. The latest information shows that 3 commodity vessels crossed the strait on Saturday, followed by 2 on Sunday and 6 on Monday. Monday's figure was a small improvement, but it remained below the recent daily average of 11 vessels. No very large crude oil tankers or liquefied natural gas carriers were recorded passing through on Monday. The United States Energy Information Administration expects Brent crude to average approximately $85 a barrel in the third quarter. This is $11 higher than its previous forecast. Continued disruption could keep energy, transport and aviation costs elevated. It could also slow progress on inflation, potentially limiting how quickly central banks can reduce interest rates. Now to an important deadline in the Canary Islands. The Canary Islands Special Zone, often referred to as the ZEC, provides qualifying businesses with a 4% corporate tax rate on eligible income. This compares with Spain's standard corporate tax rate of 25%. The current registration window closes on the 31st of December 2026. Businesses successfully registered by that date can benefit from the regime until at least the 31st of December 2032. However, the ZEC is not a simple registration option. A business must conduct an approved economic activity, make a minimum local investment, create and maintain a required number of jobs, and establish genuine business operations in the Canary Islands. The requirements vary according to the island, business activity, and individual circumstances. For businesses that have not yet started the process, the practical deadline may arrive well before the end of December. Preparing a business plan, demonstrating the source and purpose of the investment, and completing the authorization process all take time. British or American entrepreneurs already in the Canary Islands or seriously considering establishing operations there may wish to assess their eligibility before the final months of the year. The potential tax rate is attractive, but it should be considered alongside the commercial purpose of the business, Spanish tax residence, the owner's personal tax position, and the costs of maintaining the structure. Belgium also has an important August deadline approaching. Belgium's new 10% capital gains tax applies to many financial assets, subject to exemptions and special rules. For investments held through Belgian financial institutions, the default position is generally for the bank, broker, or insurance provider to withhold the applicable tax automatically. Investors can instead opt out of automatic withholding and report their gains through their annual Belgian tax return. For gains realized between the 1st of June and the 31st of August 2026, that decision must be communicated in writing to the financial institution by its own deadline. In all cases, the final deadline is the 31st of August. However, an individual provider may impose an earlier administrative cutoff, so it is worth checking the provider's requirements now. Opting out may allow an investor to account more directly for the annual exemption, eligible losses, and relevant acquisition values. However, it also transfers more of the calculation and reporting responsibility to the taxpayer. The right choice depends on the portfolio, available exemptions, gains and losses, and the individual's wider tax position. People who moved into or out of Belgium during 2026 should pay particular attention to asset valuations and their dates of residence. Separate valuation and exit tax rules may apply. And finally, Malta has clarified its year-end application rule. Malta's new individual tax program takes effect on the 1st of January 2027, replacing several existing residence-based tax programs. The 15% rate on qualifying foreign income remitted to Malta is preserved. However, minimum annual tax liabilities and qualifying property thresholds will be higher. An important transitional point has now been clarified. Applicants who formally submit an application on or before the 31st of December 2026 and are subsequently approved can remain under the existing rules until the 31st of December 2031. Formal approval does not necessarily have to be received before the end of 2026. However, the application must be properly prepared and submitted by the deadline. Assembling the required accommodation, financial, tax and due diligence documents can take time. December is therefore not the ideal moment to begin. This week illustrates two sides of cross-border financial planning. Market movements can change currency values, investment expectations, and living costs quickly. Tax and regulatory deadlines move more slowly, but missing one can have longer-lasting consequences. Every situation is different. Residence history, nationality, assets, pensions, business activity, and future plans can all affect which rules apply. The earlier you review your position, the more time you have to understand the available options before a deadline arrives.
And that wraps up this week's Market Snapshot. If you'd prefer to get the information before it's published here, you can sign up for the update directly on our website. Just visit chasebuchanan.com and subscribe and get the update delivered straight to your inbox, giving you a head start on the week. Thanks for listening to Expert Money Matters. I'm Georgina. Join us next time as we explore money matters for your life abroad.